Welcome to the NISM Masterclass. I'm your host Shashi Krishnan. Our purpose at NISM is capacity building in the securities market ecosystem, and as part of that purpose we sit down with the gurus of the securities market to learn and understand from their journey. And I'm sure that all of you who are joining us in this masterclass today will gain immensely from the conversation that we are going to have. And my guest for today is Soumya Rajan. Soumya is the founder and CEO of Waterfield Financial and Investment Advisors Private Limited. And Waterfield Advisors is the largest multi-family office and wealth advisory firm in India. So welcome to this masterclass, Soumya.
Thank you very much, Shashi.
Let me start off with your journey in Waterfield itself, because you set up Waterfield Advisors in 2011, and that was a full 2 years before. So that must have been a paradigm shift in the way wealth management business was being done in this country. So could you quickly take us through your journey, prior to when these regulations came in and after these regulations came in, and how has the entire wealth management space evolved over these last 15 years?
Thank you very much for having me, Shashi, today. And one of the things I saw was when I started Waterfield was essentially to try and understand what was happening in the ecosystem. I was a career banker with 𝐒𝐻NIs and then Standard Chartered, and I was heading the private bank for Standard Chartered between 2008 and 2010. 2008 was the global financial crisis, and that was the time when you saw a lot of family offices getting created in the US, primarily because families, clients were very unhappy and in some instances actually angry with their banks because they had certain positions in terms of what the banks held in terms of their proprietary balance sheets, and what they were selling clients as products was completely different. So you saw, and I was reading more about this proliferation of family offices that was happening. I was looking at that data and was reading articles about family offices and realized that this is going to happen in India as well. It's only a matter of time. At that time, we were a distribution-led wealth management industry. Everyone was making their money through basically the selling of products and earning commissions on those products. Right. My sense was that given the corrections that had happened in markets, while India was largely unscathed at one level, it still did mean that clients were going to be reading more about this, and this as a business model was going to emerge. That's what prompted me at that stage to leave a corporate career behind and found a business which was essentially conflict-free and where we would earn our fees only from our clients. I will say the early days were very rough, Shashi, because at that time you didn't have the registered investment advisory guidelines available. Right. So when you went to a client and said that I will take my fees only from you, they would turn around and say that, well, I am going to be paying distributor fees, I'm also going to be paying advisory fees, and it doesn't make sense. Right. So I was actually quite crestfallen. I actually thought this business model is not going to work. I was probably ready to actually close the doors on Waterfield a year after starting it, because I said India is not ready for this, it's too early. But at that time, one other development happened on the regulatory front, which was the distributor versus direct NAVs. Right. That came out for mutual funds. That came out in September 2012, and that was a year after Waterfield started, and you already heard the noises from the regulator at that point. So that was really what prompted my desire to also stay the course, to actually build a business around this, because those two pieces of regulation around the direct versus distribution, which was in mutual funds, because even today, even though you may be a very large client, a bulk of your assets still do sit in mutual funds. Right. It's not as if it's migrated to either PMS or AIF, because those are much newer forms and vehicles with which you can invest. Right. So mutual funds was still always the dominant vehicle, even today. And that's when I said, all right, this is a business that has legs. And fortunately, the regulatory support we've also got has been tailwinds for the business ever since.
Yeah, so if you look at the direct versus, the distribution-led thing, you now had the ability to sort of charge for advice and the customer not pay for pay the agency commission and stuff like that.
Exactly. And I think the beauty of that is that most clients don't realize that your distribution fee is actually coming out of the performance of the product. So when you're getting a return on the product, and you're going through a distributor, the fee is coming out of that. Whereas if you were to take that out, and even if you charged a lower advisory fee, you're able to then get more by way of return, and also it compounds for the longer period. So these are two innate benefits of just going direct vis-a-vis going through a distribution.
Right. So you were talking about how the financial crisis or GFC sort of changed the entire way people looked at the wealth management space. Yes. And why they wanted now independent wealth managers to look after their portfolios, and people started setting up family offices. So in India too, I think since you set up Waterfield, you also saw this big crisis that happened during the COVID period, right? And I mean, in that period, obviously, we saw huge volatility in markets, equity markets corrected significantly, investor sentiment bottomed out. And obviously, there would have been a huge amount of learnings because you weren't there in the GFC period, right? India didn't have that, evolved wealth management space in those days. But the COVID would have been, great learning for people in the wealth management business because, especially given the fact that this must be also, I think, a lot of the customers must have also faced, huge erosions in their wealth. And, when 25–30% of your wealth sort of erodes, you tend to get a little worried. So what were your learnings from that period?
So that was actually quite right, Shashi, when you mentioned that we really saw it very close at hand. COVID was really in some ways for advisors, I think we saw the best period in terms of our own growth during the COVID period. And you would think, why did that happen? I think when I look back on it, it's because advisors then were greatly valued, because unlike a distributor that was actually charging fees in order to push a product into a client's portfolio, when you had an advisor on your side, the portfolio was constructed in a way that the products in that portfolio had a longer term meaning for the client. So we found that ultimately a client valued our advice at that point much more than they would have a distributor, and we saw people from distribution actually coming our way. What it meant for the investor was that when you go to an advisor or a wealth manager, you want them to do two things. You want them to help you in terms of enhancing the return on the portfolio, but the other thing you want them to do is to make sure that the risk is managed in the portfolio. I think as advisors, we take both of these two responsibilities very seriously. And if you're able to get that balance correct, then you can actually handhold a client during a period when there are significant drawdowns in the portfolio. When you're making an investment, what's very key is the price at which you enter that investment. Now, when markets correct, it is actually an opportunity. The role of the advisor is to guide the client at that point, saying, if we have cash, if we have liquidity, this is the point in which we have to invest. As advisors, we also do a lot of research. So for us, we would actually back test and see in all these black swan events that have happened, how long does it take for markets to recover? In most periods, we found that that recovery on the outside happens in about 12 to 18 months. So which means that if you as an investor have capital that you can continue to live on for a period of about 18 months, and let's say stretch it to 24, then you're giving your portfolio a chance to actually grow, because you're not pulling out the money when the markets are at its lowest. So I think when you design the portfolio also for a client, it's very important to understand the fundamental liquidity need that that client has, just in terms of managing their lifestyle, managing their affairs, so that when these market corrections happen, you don't panic. And I think that's the role of the advisor, to
Yeah,
handhold
so
and
two
not
things,
panic.
Soumya, if I may say, but you use the word hand holding,
Yeah.
right? Now, you then tend to play the role of, if I may use an analogy, that of a therapist kind of thing, right?
Yeah.
Where, I mean, you don't put them on a couch possibly, but,
But
so I just want to understand,
Yeah.
how difficult or easy is that? Because, when markets are very volatile,
Right.
most people tend to panic very quickly, and you must be spending a lot of your time trying. I mean, like for example, today
Yeah.
markets are correcting quite significantly. You've got a 7% correction in public markets, and a lot of the private markets have become illiquid. So I'm sure customers must be sort of getting a little worried, and coming back to you and say, "What now? What do we do in this kind of a situation?"
I think, Shashi, the key is actually communication. Right through the period, most times if you're in the distribution committee, markets correct, the person is never there to talk to the client.
Correct.
They've just disappeared.
Right.
I think the advisor at that stage is over communicating. I remember vividly during COVID, I would probably have weekly calls with clients just to update them on markets. And it wasn't as if it was, while my team was also there, I was literally on every call just to assuage what clients were sensing and feeling. You're right in your perception of almost like a therapist. I call myself almost like a financial doctor, which is the role that we have to play. And it also means that clients have to be very honest with their doctors. They have to tell them exactly what is their situation so that we can make the correct diagnosis. So it's two-way. The client being very transparent and telling us their situation, us being able to say, this is the best way in order to navigate.
So let me catch you on that. You said clients need to be transparent, right? They need to tell you what exactly their situation is.
Yeah.
I mean, how many clients actually do that? Because somewhere clients are a little reluctant to share all their information, even if he's a very trusted wealth advisor, for reasons best known to them.
Yeah.
So isn't that a challenge?
So that's one of the reasons why we actually set up Waterfield, Shashi, is because we were looking at two things. One was just having a conflict-free advisory opportunity to advise clients. But the second was what I believed was holistic wealth management. And when I say holistic, in India we tend to equate wealth management with investment management, whereas the broader concept of wealth management is around succession, is around your family governance, it's about conflict in the family, it's about philanthropy, it's about the right investment vehicles to use. Unfortunately, not enough organizations in India are spending time on this, because ultimately it's a factor of time. It's not a function of giving a piece of advice which you can roll out to 20 different families or 100 different families. It's about understanding what is unique to that particular family and addressing it. And I feel somewhere that is the essence of what we, for instance at Waterfield, we want to bring, that wealth management is holistic. We want the client to be able to share whatever is their situation so that we can then give them the right advice.
Okay. So you're
harder said than done.
Yes, yeah. So if you sort of are able to get a client to understand that this is an end-to-end holistic kind of service, the chances are that he'll be a little more game open to share more information with you.
And I think the way I would look at it, Shashi, is that ultimately in your generation, you are the custodian of the wealth, right? You want to be able to pass it down to subsequent generations. If you start having a very short-term view on how you manage your investments, then you may dissipate it in the course of your own lifetime. Our role is to be able to handhold the client to think about their investments, not just from their own years in which they're alive, but also how is it that I can pass this on to subsequent generations and make it more meaningful. In which case, your entire investment philosophy itself will change when you start looking at it over the longer term.
So in spite of we doing all this, I mean, providing an end-to-end holistic kind of service, the space is still very small. I mean, you have 300 family offices in India, you've got about 15,000 ultra HNIs with a net worth of over 250 crores, maybe you'll have around about 100,000 HNIs with 10 to 50 crores of net worth. So how do you see this expanding? How do you see more people sort of adopting the services that you people have to offer?
I think, Shashi, a lot of it has to do with just awareness that such business models or companies even exist. I think for a lot of players or a lot of clients, they may not even be aware that even their existing wealth manager who they're working with may actually have an advisory offering, because the distribution revenue is so lucrative. And advisory is much lower than that. It's very hard for a relationship manager themselves to tell a client, well, please move from distribution to advisory, because they in some ways will be cannibalizing their revenue on which they get their incentives.
Right.
So I feel that unless more organizations recognize that this is the way forward, clients are seeking transparency, it's going to be very hard for this to become more mainstream. But the intent is that as awareness grows and as families and clients realize that there is a better way in which I can access these opportunities, they will shift there. So I think at Waterfield, I think we're beautifully placed.
But how big do you think this market can get to be?
I think it could. So if I look at developed markets, registered investment advisory is about 60% of the market. In markets like the US. In the UK, it's 100%, which is advisory because that's a regulatory requirement. In India, it's about 15% currently. So given the fact that you have a huge financialization of assets, which is about to unlock, and you have under-penetration in terms of just professionally managed services, I think there's a massive runway in this space.
So it moves from 15% to 100%?
No, I don't think so. But I think even if you were to double it, I think that in itself is a huge expansion in just the market itself. Shashi.
So getting back to the Investment Advisor Regulations 2013, it requires, three investment advisors to do three things, right? One is risk profiling.
Yeah.
And, this risk is a term which most people don't tend to understand. Everybody comes to you and say that, I've got a great amount of risk tolerance, but, when it actually comes to an event, people don't act the way they believe that they should be acting. The second is in terms of suitability, because I think the Act requires you to, advise based on, what the investment objective of the client is, what his risk profile or her risk profile is, what his or her financial situation is. And lastly, you need to make as investment advisors as wealth advisors disclosures in terms of conflict of interest. And you were already talking about conflict of interest, because they are a set of institutional wealth managers who could potentially could have conflict of interest. So from a wealth advisor's perspective, how do you manage these three things: risk profiling, suitability, and disclosures on conflict of interest?
So we did something slightly different, Shashi, at Waterfield. We adopted what we called a risk pool basis when we were advising on a client's portfolio.
Okay.
So what we basically said is that any capital that a client would give us, first we would take out for any immediate expenses, liquidity requirements that we saw in the next 24 months, kept that aside. And then we created for that capital 3 risk pools. So one risk pool was what we call the safety pool. The safety pool was basically to the point which I was making earlier about black swan events. In the event that something very untoward happens and you don't want to risk all, and you want to be able to make sure that your family is secure, you keep a certain portion in what we call the safety pool. That would be typically into instruments which were like fixed deposits, tax-free bonds, really not risking principal in that sense, but you may or may not be getting a very, very marginal or small rate of return. But what was important there was also a little bit of liquidity that you could access if you needed to. That typically for families is about maybe 5 to 15% for any client today. You could call it like the emergency pool that any client keeps. Then on the other side, we had what we call the growth pool, which we said very illiquid in nature. You're not going to be in a position to touch that money. You may not get the returns for 7 to 10 years. Typically, it would be something like private equity and venture, unlisted investments. And then we would say you keep a certain portion for that as well. And that would typically for families, I remember when I first started out, would be about maybe 5% or so, grew to about 15 to 20% now, and that forms what is the growth portfolio. Everything else we said is what we call the market pool. So that is typically your listed equities, your listed fixed income, your REITs, your InvITs, your gold, anything that you could mark to market, mutual funds, which you could trade. And you got a daily NAV. That would all come into your market pool. Now, when we segregated portfolios on this basis, then in some ways we were already taking care of the risk element in terms of what was required from the risk point of view for a client. Suitability of the products was then where we were looking at what is the, what we called an, after we created.
If I may interrupt you, therefore when you did your risk profiling,
yes,
you would basically say what portion basis this risk profile would go into these three pools.
And then you would also have an investment policy document.
Right.
For us, the governance is very important.
Right.
And the whole concept of financial planning is very important.
Right.
I think what we saw in most client portfolios in the past is that they would be first headlong, they will jump into allocating to a product.
Correct.
Sometimes the product is not even relevant in the portfolio. So what you really want is to say, let's pause, let's take some time, let's understand and create the financial plan, let's create the boundaries. Once you've created the boundaries, then we can get into asset allocation and then fund manager selection. Because these, I think what tends to happen is the sequence with which you make investments should be about what are my objectives, what are the risk pools, what is the asset allocation, what is the fund manager selection, and then what is the cost of investment. If you don't follow it in that sequence, then you will make a mistake. So I think adherence to process is extremely important when you are investing and having a certain discipline around it.
So, when you're looking at this suitability, obviously you're looking at the investment objective from the perspective of the customer. Now, everybody's investment objective is to, I want to maximize whatever returns I can get. I mean, I'm sure, and nobody else gives it, nobody would tell you that my investment objective is different from that. How do you sort of temper down that expectation?
It's very tough, Shashi, I can tell you, because I mean, I keep telling clients it's not about maximize, it's about optimize.
Right.
That's the word that I typically use with clients. And I would say that, and I think here when you have your risk profiling, you're asking the client and you're putting them through a set of questions where you're saying and you're showing them this is the kind of drawdown. Would you be able to sleep at night if your drawdown came to 50% of the portfolio? Now, when they are looking at that and answering that question, then you realize, and they themselves realize, what is their risk appetite and what is it that they can tolerate. I think ultimately it's about the tolerance of risk which you can manage. I will say family offices have a larger propensity for that drawdown because they don't need the liquidity.
Right.
So it's very important to judge what is the liquidity requirement of any client first, and then after that, then craft and create the portfolio appropriately.
And lastly, in terms of the disclosures that you need to make to customers or clients in terms of conflict of interest.
Yeah.
Now, you could very well tell me that independent wealth managers don't have conflict of interest, but I'm sure there could be some areas where you do have conflict of interest where you need to make these disclosures.
I think everything is about transparency for the client more than anything else. What's wonderful about the RIA business and for us at Waterfield is that we are a fee-based only advisor, which means that we take our fees only from our clients. There are a bunch of other institutions that have distribution as well as advisory, and the SEBI has also come out with guidelines saying if you can't be both a distribution and advisory client to the same group and so forth. But I definitely think that for us, it's very easy. We can sleep very well at night because we only take our fees from our clients. May not be as easy for some other institutions, but this is the path that we've chosen.
Okay, so now, if that is the way you go about doing it, how does a customer sort of understand that this is a reasonable fee to pay for the sort of services that I'm receiving from Waterfield or any other investment independent wealth manager?
Great question. SEBI has mandated that for registered investment advisors, the maximum fee that you can charge as a percentage of the assets is 2.5%.
Right.
We are nowhere near that in terms of most other registered investment advisors. I don't think are charging those kind of fees. But what it did do when it did happen is that it allowed the fees to get linked to a percentage of the assets, so that when the client's assets grew, your income as well, in order to provide those services, also grew. One of the challenges that was there in the early days of the registered investment advisory framework is that you had organizations that were allowed to do both distribution and advisory. Right. So while they were getting a bulk of their revenue from distribution, they were linking their advisory fees only to a flat fee. That really was a big disadvantage to organizations, including ours, because what ended up happening is that you charged fixed fees and then the assets grew, and then your yields in terms of your assets that you were managing kept coming down. So a wonderful way in which the regulator unlocked that was to say link it to a percentage of the assets.
But so my question is 250 basis points reasonable, or is 50 basis points reasonable? That's the question I'm asking.
So globally it's around 1%, 1 to 1.5%.
Right.
In India, the advisory fees are typically between 30 basis points to about 60 basis points. I haven't seen it really go beyond that.
So then that answers my question, that people are still not willing to pay, a reasonable amount for good advice. They still want to sort of bargain, as is the natural tendency.
But I think that's, but no, it's interesting, Shashi, that you should say that, because one of the things when I first set up Waterfield, everyone actually told me Indians don't pay fees.
Right.
So why are you even
that's what we intuitively tend to believe.
That is what was told to me, that Indians don't pay fees, why are you even doing this business? But I just felt that as you pay your doctor and you pay your lawyer, and you pay them because you genuinely perceive them to give you a value addition which you are not able to access, that comes at a cost, and in terms of a fee that you should be willing to pay them. What it does for the registered investment advisor is that if you're getting your fees only from your clients, you are always on your toes, because you are always, every time you raise that invoice for the client every quarter, you are justifying your existence in many ways. So I actually feel it's a model that doesn't let complacency come in, actually allows for improvement, because you're constantly trying to do more and better for your client.
You were talking about these regulations that allowed you 2.5%, up to 2.5%, so that it sort of evened out the fee rather than a fixed fee that you would get. In January 2025, SEBI's come out with a further set of regulations relating to investment advisors. I mean, how do you see that changing this landscape?
I think there are still very few registered investment advisors. If you looked at the numbers, probably close to about 1,000 registered investment advisors, as opposed to 125,000 distributors.
Correct.
So it's like we're probably a needle in a haystack as far as the intermediary is concerned. But I think the new regulation has at least helped in terms of allowing for some of the criteria based on which you could register as an investment advisor earlier. Those have been relaxed.
Right.
If you were it had to be a postgraduate before, it's now a graduate.
So you see more people entering this space?
I think what I was particularly interested in was, I think, a directive which was around part-time advisors.
Yes.
And I felt that was a very interesting and novel concept.
So if you're a chartered accountant and you had these professional qualifications, you could
do that.
To what you normally do, also become an investment
So
advisor.
Clearly there is intent to widen this.
Right.
Ultimately, our business is still very high touch at one level, Shashi. So when you need more people to be able to be locally available to individuals and families if you want to be able to at one level grow this. So of course there is the whole role of technology, and which is also very important. But in the current way in which a lot of wealth management happens, it is about advice that you get from your chartered accountant or from a group of individuals who may be just operating in a smaller location today.
Right.
I think those are very important, and the fact that we're relaxing some of those criteria to make it easy for people to set up such institutions, I think is relevant just from a financial inclusion point of view.
Sure. My next set of questions, Soumya, relate to some of the core activities that wealth managers and investment advisors do relating to investment management, continuity planning, and the operation pillar of your entire business. So coming back to the investment management, because most of us tend to, as you yourself pointed out, say that we look at wealth managers only providing investment management services, but that's, I think, a very, very important part of what they do provide. So how do you go about designing an investment strategy for an ultra hedge? Now, you did tell me about these risk pools, etc. But within these risk pools, you would also have to do asset allocation between, say, in the market pool, for example, between mutual funds and PMS, or in the what do you call it? What was the second pool?
The private markets and the growth pool.
The growth pool, which you call, which you named it. The growth pool you need to do between private markets, and in the private markets between venture and private equity, or in the market pool between REITs and InvITs. How do you go about designing the investment portfolio for an ultra high net worth individual?
What's interesting is that when we do the risk pools also, Shashi, we also try to benchmark it to what is the kind of return that you could also expect from these risk pools. So typically what we want clients to look at is inflation. We want them to benchmark their portfolio against inflation. So for each of these risk pools, we actually say, in your safety pool, let's try and see, can we just cover inflation? We may be a little below inflation, but the aim should be to try and cover that. When we look at the market pool, we're saying CPI, the consumer price index, inflation, plus at least about 5 to 7%. In terms of what should be the returns that they get overall on the market pool. And then
5 to 7% over inflation?
Over CPI, over CPI. So it'll come to around 10 to 12 is what you would expect.
That would be the blended return.
The blended return on the portfolio.
On that market pool.
On that market pool. And then if it is greater than it's your growth pool, then we would say CPI plus 7% at least is what you should get, which means private markets will give you somewhere, whether it's private credit, whether it is private equity, venture capital, you want upwards of 15 net of fees is typically what we would look at. Though most of them trend towards 20 is what we would like to try and get to. Now, once you benchmark that in terms of CPI plus this certain levels that you want over and above inflation, you are then sitting with the client to understand what should be that construct of the portfolio. But equally, when you create the asset allocation, it is a strategic asset allocation. So for instance, within equities, are we tilting more towards large caps? Are we tilting towards mid and small caps? What is the macroeconomic environment? Where should you be taking money off the table? Where should you be allocating? Also, if you're in large caps, what is the vehicle you're using to invest into large caps? In the past, for instance, we would always say, many of the active managers are not really outperforming the index. So do you really need to pay a very high fee, even for a mutual fund in active management in large caps? Because if you were to take the index, you would be just as well off as if you were to put into a large cap manager. So are you better off then looking at taking your allocations for large caps only through passive indices, and then for your mid and small caps, because you need people who can research the underlying portfolio better, or the company portfolio company better, are we better off giving it to actual managers to look at this entire space? And you would then direct yourself towards small and mid cap managers who would be the right choices. For us, when we're choosing a manager, consistency of performance is extremely important. We do not want that manager who is quartile 1, quartile 3, then quartile 4, then back to quartile 1. That is not what we're looking at. We want to see managers who are consistently in the quartile 1 and quartile 2, because that then tells us that they are able to also weather these significant turns in the market. So for us, we want to be able to create a portfolio which has few products, because the other mistake a lot of clients make, is that you want to test multiple products, you want to put little money into different things. And ultimately, if you have a winner in that, then it's hardly moved the needle. And I always tell clients, if you've got too many products and too little allocations, you might as well just buy the index. It's not making any difference. Spend the time to diligence the manager. Spend the time to understand what is their track record. Spend the time to understand their investment thesis. If you don't do that, then it's a wasted opportunity for you. But once you've chosen the manager and you've allocated to the manager, stay with the manager. Just because he or she is having a bad outcome doesn't mean you should pull your money out. If your fundamental belief in that manager is there, you should stay with that manager. So those are some of the things that we kind of try to educate clients on.
So when you're talking about, say, a 12% blended return on your sort of market pools, does it then mean that they have very, very low allocation to, say, let us say, fixed deposits and debt funds and stuff like that? They are mostly to growth assets? Because
So
12% is a fairly sort of challenging...
10, I would say 10 to 12 is where it will moderate to, Shashi, is what I've seen. And here again, there's another interesting concept that's come out more recently, which is around, you have very traditional asset allocation, which is equities, fixed income and so forth.
Correct.
Whereas that actually failed during the global financial crisis, because people had a lot of money in fixed income, which actually lost money. So what people thought was safe portfolios suddenly became the reasons why they lost capital. One of the things that we're exploring at Waterfield is what we call the total portfolio approach, which is to say that there will be parts of your portfolio which are equity-like in terms of their returns. So if it is, let's say, high yield fixed income, if it is distressed fixed income, if it is special situations,
or venture debt,
these are all like equity-like returns. And what we would try to do when you look at the market, when you look at the risk pools, the safety pool actually becomes the core, what we call traditional fixed income that you're sitting with. And the market pool becomes like your equity-linked, equity-like products, in order to make sure that if something goes wrong, then the risk is well understood. And I think for me, the big thing is the understanding of risk, because otherwise people will say, I put it into venture debt, I put it into a high yield credit, but they will not realize that the loss of principal is as high if underwritten wrongly. And clients don't understand that. So the articulation of the risk, even on the fixed income side, I think when you take a total portfolio approach, you're able to then guide the client better in terms of what to expect in terms of returns from that kind of underlying risk that you take.
So talking about this liquid pool, how big, you said 15% is what you normally would advise your customers.
The safety pool?
The safety pool or the liquid,
it varies from 5 to 15%.
From 5 to 15%.
Depending upon the client.
So does a client then get to reassess how big that pool should be, whether his risk appetite has changed, whether he should move money out of that safety pool into riskier assets?
Absolutely. And we do this typically once a year. And what we find is that for larger portfolios, it doesn't tend to be a percentage of the portfolio, it tends to be an absolute number.
Amount,
because then when you have larger and larger portfolios, it becomes a little irrelevant to try and have irrelevant. So then we then say, let's cap it at an absolute number which the client is comfortable with, and then everything else gets allocated otherwise
to the market pool
or the growth pool as well.
So talking about the growth pool itself, right? Again, I think you did touch upon it, but people have got private equity, people have got venture equity. So how do you determine suitability out there for these riskier assets?
So here I think, the private markets is an evolving ecosystem in India. It has largely, my sense is, it has been largely missold, Shashi, is my feeling, because the commissions that many of the venture funds, private equity funds were paying to distributors was fairly significant. And that meant that a lot of clients ended up with a lot of these illiquid assets. My sense is that you have to do your diligence on them just as well as you do the diligence on any public market fund as well. And what's important is that in this particular space, the difference in performance between the top quartile funds and the next quartile is almost half of the other. So if the top quartile venture fund is giving you 35 to 40%, the next quartile is giving you around 18 to 25. So this difference in performance is stark. Likewise on the private equity side.
Right.
So the problem, I think, is that for many existing investors, they've not been able to access the best managers. And one of the things that we're trying to solve for at Waterfield is how do you access the best managers? Because the best managers do not actually pay you distribution fees. So one of the things we've tried to do at Waterfield is we've tried to aggregate the interest for investing into these funds and created a fund-of-fund structure so that you can then invest into the top quartile funds through that pooled vehicle. This space, I think, is only going to grow. What we've seen even in global markets is that, you know, the allocations to private markets, even in the last 5 years, have grown from about 9% to about 15%. In India, it's very early days. The IPO markets have been very buoyant and have given exits to private markets. But my only request is that, you know, we shouldn't be hugely exuberant. What also tends to happen in private markets is that everyone will always tell you about the bets that they have won and done well in. They will never tell you about what didn't go right. And unless you understand the risks of this and the illiquidity risk, and the fact that you make money only when you exit, that's the main key in this.
So you think that the fund-of-fund sort of offerings will keep increasing over the next couple of years, and that would be the best way for an ultra HNI to access private markets?
I think that would be the best way actually for an HNI and a retail investor to access the private markets, because the ultra HNI, what we're seeing is the family offices themselves are becoming large enough to also compete with funds. And they are competing with the funds in direct deals that they do. So my sense is that, and just to give you an example, General Atlantic, which today manages about 97 billion, originally started as a family office of Chuck Feeney, and that was the Atlantic Philanthropies. It was their venture arm, and you can see where it is today. My own sense is that other Indian family offices will emerge to be fairly large players which will compete with other fund managers. In fact, I think it's happening already. So a fund-of-fund structure for us is more relevant to someone who is a smaller ticket size, doesn't have the time to determine which is the best manager to back, but then is trusting a group of people who are in the ecosystem in order to be able to access the best funds.
Soumya, another way to diversify risk is obviously to look at markets other than your domestic market.
Yes.
Now, I do not know whether you're actually taking on more risk or you're diversifying risk or you're reducing risk. That's, I think, depending on the market that you get into. And two questions. One is that when we talk about diversifying risk, or most HNIs talk about diversifying risk, they immediately look to invest into the US markets. Now, are there opportunities beyond that for you to diversify risk? That's one question. And secondly, what mode do you use? Because you have the liberalized remittance scheme, which allows you to take, say, 250,000 USD every year and invest out there. You have, the fund structure itself, the feeder funds. But again, feeder funds have got their restrictions because, sooner than later you come under the FDI, FPI limits, and then, it closes down. And then you obviously have the IFSC Gift City route which you could take. So how do wealth managers approach that part of investing?
So I would say clients should look at a global diversification and more in terms of just risk, just diversifying their risk.
Right.
But what I've also seen, Shashi, is that they're also doing that for catering to their next generation, because many of their next generation may want to live overseas and abroad. So they're creating in some ways the portfolios for what the next generation can access outside. We have a very active program in Waterfield to encourage families to diversify outside of their India home bias in many ways. What I did see though is that, exactly to your point, they just go straight to the US and they'll buy an Amazon, a Tesla, a Microsoft, and they'll keep a bunch of kind of stocks at NVIDIA that they know, and will hold on to those. I think what they need is really a more portfolio-based approach. That's something that we've done at Waterfield. We work with a partner in the US, because what we realized is that it's not enough to just buy direct stocks. The same thing that you do in India in terms of diversification, in terms of manager selection, asset allocation is very important.
Right.
But typically you still find that even in the portfolio-based approach, 60% of allocations still do go to the US.
Right.
But other markets that we do...
And the markets have done very well there anyway.
Very well. and so no one's complaining.
No one's complaining.
But the thing is that there are pockets of opportunity. Japan was a pocket of opportunity, is a pocket of opportunity. China, which actually went, in many ways we were paused and slowed down our allocations. We are again looking at China right now. Europe again is an area that we're looking at currently. So it's important to be able to diversify across those. But here again, my view would be we need to work with partners overseas, because ultimately we are good in our own domestic market and understanding domestic India well. It's important for Indian companies to be able to work with the right partners overseas to be able to help Indian clients ultimately diversify.
And some of them would
overseas.
be registered with the Gift City in IFSC also.
Some may. In fact, Gift is very interesting. They've just opened also the new LRS accounts, which they've just advised on. I think some of the banks have just started setting that up. Plus, of course, with the tax incentives that they have at Gift, it's a matter of time before which you can actually access more of the opportunities. My sense is that the 250,000 is still for a client.
For a family office, it's actually nothing.
It's nothing. It's actually nothing. It's very small.
Right.
But I would like to look at it outside the family office perspective for a larger set of Indian clients that can access overseas opportunities. They should, because the diversification is important in the longer term.
Right. So you were talking about the tax advantages that something like Gift City gives you. So that must be a large part of what you also sort of look at while constructing portfolio. The tax optimization strategies, the wealth preservation, which you were talking about a little bit better. Then everything can't be long-term growth, right? That's one thing that people do have this tendency to say, how have I done over the last 1 year, 2 years? How do you balance this long-term growth outlook versus short-term growth outlooks? How do you manage those sort of intricacies in the portfolio?
That's a behavioral question in many ways, Shashi, because I think that's where the role of the advisor comes in. You have to educate. You have to educate that investing is a long-term journey. Investing is not about putting in the money today and taking it out 3 months from now. It's about choosing again, it's very boring. You have to have, the asset allocation, stick to the asset allocation, take off profits if you're going above your asset allocation, deploy when markets correct, and just that continuous cycle. It's a discipline. And I think that is what the wealth manager has to do. It's like hammering the same thing over and over again. And what my sense is that clients now recognize that, and they recognize that even today when I sit with client reviews, and they know that the last 1 year's performance has been, on equities, all indices have been between 2 to 5% in terms of equity returns, at best, if you were to look 1 year ago. But then they don't panic. They just know that, okay, it's a cycle. If I'm getting 2 to 5% this year, I have made 30%
last year,
the
right.
previous year.
Right.
So it's always relative, and it is in the context. And I think that's where the wealth manager is trying to put in these, just the communicating, saying this is what we've done this year, this is what we're looking to do in the coming year. For instance, this year, for instance, private markets are looking very interesting,
Right.
because they've been so beaten down. They've been beaten down over the last 2 years. We would tell our clients that while listed markets and public markets may be a little bit more challenging over the next 12 to 18 months, you could actually find very good opportunities in private markets. And those private markets, you want to do fund investments, or you want to do direct investments. I mean, it again boils down to asset allocation, because why do we even have asset allocation in the first instance? Is so that these are uncorrelated assets at the end of the day. While one is up, the other is down, and your portfolio as a whole is getting navigated correctly.
So over and above, investment management, continuity planning becomes a very important part of what you offer your wealth management clients. So whether it is, the intergenerational transfer of wealth, or, family governance structures, estate planning. So as a wealth manager, I mean, what are those services that you think are very, very important, and how does a wealth manager effectively do that? Because the core competence of most wealth managers still remain in investment management. Yeah. They really haven't built out core competence in these other areas. So I just want to get a sense from you on that.
Yeah, and I think that's a great question, Shashi. And I think we spend a lot of time at Waterfield, because one of our key client segments is business families.
Right.
We spend a lot of time on family governance. Right. And when we say family governance, what are we talking about? Because ultimately, these business families have existed for maybe the founder, siblings, cousins, couple of generations. The golden goose is the business, which is generating the cash in some sense. And they're always thinking about, how do I safeguard and keep that golden goose a golden goose? And that's when the concept of family governance and having the right structures come in. As you have more family members, there is always the likelihood of conflict to arise. Even one of the reasons why you set up a family office is really because you don't want that conflict to kind of hurt the earning potential of that business in subsequent years and subsequent generations. But that means having fairly difficult conversations with all the parties, and with every subsequent generation there are more people.
So if I may interrupt you, these difficult conversations,
yes,
are wealth managers actually sort of structured to have these difficult conversations? Because they can have conversations on investment management, but these difficult conversations are a very different league, right?
They are not, and I think that's ultimately going to be the difference between why you may have companies that do a robo-advisory and vis-a-vis companies that do wealth management. Right. Because the robo-advisory is never going to be able to have the nuances that the wealth manager is ultimately going to be a privy and party to. But the structures that we do recommend is that having a family council, creating a family council, having a family constitution if you need one, having an investment policy document, having an investment committee, making sure that in the family council, one of the biggest issues is a discussion around allocating capital for a new business. So let's say one cousin comes up and says that, I have this new business that I want money for, and then there are uncles and aunts who are opining on whether this business is relevant or not. You want to be able to have a formal structure that evaluates the opportunity, and then if one opportunity is given to one cousin, then other cousins should also have access to similar opportunities or to present their case. So everything is about treating everyone fairly, so that even though it is a family and there are clearly blood relations which are there, you want to make sure that it's also, there is a process around this also. That is what I'm seeing families actually now also kind of recognize that they need this. And I think the last governance piece that's very important for families is educating the next generation. So whether it's educating them on investments, or a way in which many families do that is through philanthropy, because they say that if there's a corpus which is there, which is being managed by the philanthropic foundation, can I actually have my next generation manage those investments, because then they know that whatever is being generated is going for a good cause. One of the issues that most business families have always had is that how do you make sure that the next generation doesn't have a sense of entitlement, and that they've come into this wealth, but then many families are often too scared to also tell their next generation how much they actually are worth. So these are the questions that we as wealth managers do need to help our clients with.
So I'm curious to know who does this job in a wealth management firm, because I'm sure if I were a family office and I needed to bear my family secrets to a third party,
Yeah.
I mean, I wouldn't do it with a relationship manager, isn't it? So how does it work?
Yes and no, Shashi, because I think some of the relationship managers, at least who we have in our company, very seasoned, very qualified. They all have 18, 20 years of experience. So they're coming from having seen family, business cycles. But also what we want to do as a company is that we have a huge amount of knowledge that's come because we've been working with families and helping them through some of these difficult phases. I keep using the word difficult because they're prickly conversations. But to be able to take that knowledge and see how one family navigated something and bring that best practice to another family and to help, kind of ease their stress and tension. That is, I think, the role that relationship managers and individuals can do. The challenge, though, Shashi, is just the shortage of talent. There aren't enough people who are either equipped in this space, sensitive to what family dynamics could be, and really being able to work through with families on this. So I would only hope that as the years pass, and there's a huge intergenerational transfer that's happening, almost around 128 billion is going to transition from one generation to the next in India over the next 5 years. We do need to have people who are able to work with families through this process.
Which brings me to another question, that given that we are going to face an inheritance generation, right? The way they look at money, the way they look at wealth, the way they look at their own businesses, for that matter, is very different from the fellow or the founder who sort of set up this and his own sweat and toil built up a business. For them, this may not be very relevant. They may be looking at new opportunities.
Absolutely.
So how do families handle that?
Family constitution is a great way. Family council is a great way for them to at least have the processes and the structures in place to discuss some of these issues. The challenges that most families have is today they don't even know how to surface the issues that the next generation has. So what you want is to be able to find a mechanism where communication is even possible. But your point is so relevant. When you're speaking, one of the things that came to mind is when they look at investments, studies recently showed that 76% of millennials were very conscious about ESG, as compared to only 32% of baby boomers when it came to their investments. Now, you are then dealing with a family that could have a baby boomer and a millennial, which has a very different outlook in terms of how those investments should be made. So, being able to have an investment policy document, an investment committee, is at least an area where you can create a commonality to say that, yes, baby boomer understands what the millennial is looking for, and the millennial is also aware of what is their role as a custodian of wealth for future generations.
Then finally coming to the operation side of wealth management, because I think we can't ignore that. Technology must have sort of enabled this space in a very big way and brought in a lot of efficiency and savings, I think. But I think more important is, how do you go about this transparent reporting that you need to make to clients? Because at the end of the day, I think one of the reasons why clients are a little reluctant to give money to wealth managers to manage is because sometimes they really don't know what they're getting into, and there is very little reporting that happens. And even if this reporting happens in terms of performance, obviously many wealth managers tend to report performance that sort of shows them in good light. So how do you get in this transparency in reporting, at least on the operations side?
Yeah, great question. I think that's actually one of the challenges we've always faced, is as a wealth advisory company and multifamily office, we want to be able to provide a consolidated view for our clients. And that means we have to get reports from multiple stakeholders. So mutual funds are giving us data, PMS is giving us data. The PMS, we just don't want the month-end data, we want every transaction in the month.
Correct.
We then have the AIFs, which is the private equity and venture, giving us data. It is very challenging. My hope is, and I hope it happens sometime, is the role of the account aggregator to be much more with more teeth in many ways, Shashi, because if they can do that heavy lifting, then that heavy lifting doesn't need to be done by the wealth manager. Because when you just see bits and pockets of your portfolio, you are never seeing the full risk that you're sitting with, either in terms of exposure risk, concentration risk, you have no idea. So we at Waterfield pride ourselves actually in consolidating everything, but it is a Herculean task, you know. And so I would hope that technology, we find the ways in which players like account aggregators come in to do that heavy lifting, so that what wealth managers do when they use technology is on analytics, because that's the role that we have to play.
So when you need to report back to your client,
yes,
do you give him the blended or her the blended return of the portfolio, or do you need to disaggregate it and tell them how is each of your how each of the parts perform?
So what we do is we actually benchmark every product to its category. So if it's large cap, then we'll use.
And then you need to report.
And then we have a blended benchmark that we create based on the weighted average allocations for the client. We then determine the blended benchmark for them. I would hope, but again, a lot of this is what you want. You know, you want good AI. I actually think AI is going to transform the wealth management industry, and I feel that that's the future. Shashi, it will
simplify things a lot for you.
Hugely, because I think ultimately what will AI do? We are always working with vast amounts of data. So whether it's in public markets, whether it's in private markets, the data will allow us to see early trends. And one of the roles that I know that I'm going to be spending much more time on is to see how can we use AI for the information and data that we have in various categories to catch the early trends of what is, you know, coming around for us. I think it's going to be an extremely exciting phase. Most people would be very worried about, I think, what is AI going to do? Is it going to disrupt, you know, my business and so forth? I think it's just going to be able to match the client suitability and the client risk, and for us to be able to see a product, and particularly for investment advisors, wherever that product's lying, to be able to say that this product is very suitable and specific for you, and really creating personalization at scale, which is what we would never have seen before. So very exciting.
So while on AI, I just wanted to get your sense in terms of what will be the role that fintech will play in the wealth management space. As much as, you know, AI will help you sort of sift through vast amount of data and information, and also help you in terms of, you know, calculating blended return, etc., etc. As a platform, do you think wealth advisors will move into, you know, these fintech platforms, or do you think that ultra HNIs and HNIs, you know, are not very comfortable with this low touch kind of model?
I think the future is going to develop to become a hybrid model, where you're going to have, or not just, more than hybrid, I think we are going to have an omni-channel way in which we engage with clients. There will be times when the client will want to pick up the phone and speak to you because they may have a specific life event. Maybe they have a child with special needs, or they have they've lost their job, or they're going through a divorce. Now, these are very specific life events that happen to people, where they will want to pick up the phone and speak to their relationship manager. But there will also be times when you have advised on a portfolio and they know exactly what they want to buy and sell.
Right. So they can
and
just
they
go
online and onto the platform and execute
Right.
the trades themselves.
Right.
So my sense is that the future is a mix of both the hybrid as well as the engagement. And the engagement in terms of the human interaction is going to be on all those areas that we spoke of earlier,
Right.
which is around governance, around tax optimization, it's about wealth planning, philanthropy, succession. Those are the areas where wealth managers will automatically need to create competence if they want to remain relevant.
So just a question on the side. I think SEBI came out with this concept of an accredited investor.
Yes.
And I think the idea was that many of these ultra HNIs and HNIs would then become accredited investors, and then they would have access to more complex products, etc., and they have a better understanding of this entire space. But today you barely have around 200 accredited investors. So how do you get more of these ultra HNIs to see value in becoming an accredited investor?
I think right now they don't see value because there is no differentiation.
Okay.
So they can access the same products as anyone else can, and therefore there is no benefit that they perceive when they are becoming an accredited investor. The intent of the accredited investor in overseas markets was that there are some products that only an accredited investor can access.
Yes.
That hasn't happened in India as yet.
Okay.
So when that happens, and when you can say that because it is more complex, the risk is better understood, and I can then say only an accredited investor should have access to this, then you're creating or at least differentiation. Today the differentiation doesn't exist. So why will somebody even want to become an accredited investor? I think that's the question. Once we do have greater complexity in products and where risk is, again, ultimately the regulator is always trying to safeguard the interests of the retail investor. They don't want the retail investors to get burnt. So once you know that you're giving the you're creating this accredited investor class, then they should be able to know that this is the risk that comes with that. We haven't seen that yet, and I think that's a bit of the problem, Shashi.
Yeah, I have just two more questions for you, Soumya. One is that most wealth managers sort of cater to a population in the top 10 cities of this country.
Yes.
They really haven't gone beyond these 10 cities. But you have a large number of cities in India today where there's a tremendous amount of wealth. I mean, wealth managers haven't just gone there for reasons best known to those wealth managers. So how do you see the opportunities out there? And secondly, you have a large number of non-resident Indians today who have created a great amount of wealth in geographies beyond India, and many of them want to come back and invest into India and do something to participate in the investment story in India. So how do you access those markets, the beyond top 10 cities and the non-resident Indians who live outside India but have got a great amount of wealth?
So I think the top going beyond the top 10 cities is really the next decade or the next 15 years for India, because to your point, Shashi, wealth is getting created across the board, not just in the bigger cities and metros, but right through in tier 2, tier 3 locations as well. Accessing them is really still a challenge, and that's where I think the hybrid model comes in terms of tech plus the human interface. What I have seen is that ultimately, when you're doing the human interface part, you have to also develop the competency for people who are local or as close to local as can be in order to be able to work with those clients. Because ultimately, there is a sense and a need that can I pick up the phone and speak to somebody if it is a very important life event which is happening to me, which is relevant from a wealth management perspective. So getting that.
So if you want to talk to a high net worth individual and say Tirupur, you better go and talk to him in Tamil, otherwise he will just not relate to you.
That is true. That is true. But you need to have individuals who are competent enough to be able to reach out to that individual and say, well, I'm here to help you. But again, I come back to just the talent shortage that we have in terms of people who are able to talk to clients on a much broader set of issues, because that's what the client is looking for. I mean, we always develop and create our businesses thinking that's in our interest, and we'll just shove it down the client's throats, and this is what they want. That's not true. You speak to a client, the client will tell you, I want a holistic wealth manager. I want somebody who will tell me what's right and what's wrong, what's good for me and what's not good for me. Who will hold my hand when the markets are coming down, and tell me what I should be doing. I mean, that is the level of communication at one level you're also looking for. But we need to be able to have more individuals who are willing to put themselves out there to do more for the client themselves.
But do you think that the banks, non-banks, the institutional wealth managers are better placed to do this as compared to, say, the individual wealth managers?
The biggest frustration, Shashi, that I've heard from people who are served by banks is that their relationship managers keep getting changed.
Right, you're right.
So then, I mean, and not that you don't want the RM to grow, the RM must grow. But that's the challenge for families, because they kind of bear their soul to one person, and then that person has suddenly got transferred somewhere else, and they have to start all over again. I think that's why you still have the concept of the IFA, the local IFA, or the institutional wealth management players, because there is almost a sense of, there is a longevity in some sense for that person working with the individual or working with that organization, which makes it a little easier. Of course, it makes scaling much more challenging, because then it's very individual specific. But nevertheless, I think that's what I see as the constant refrain from families, that my RM has changed and then I don't know who to go to. But I think your question on non-residents was particularly interesting as well. Because what we see is India is an extremely attractive investment destination going forward, and most of these non-resident Indians want to be able to participate in the global investment story here. I feel that organizations that are advisory led actually are better suited to advise on these for these cohorts and client groups, because the distributor at the end of the day will only show those products or those solutions on which they are making money. Whereas there could be a wide array of fund managers, investment opportunities that are not being showcased at all because they don't pay distribution fees. And I think for a non-resident, they would want access to what is the best that is available. It is one of the areas of growth for us. We see this as a huge...
And there would be many returning non-residents also, right? And for returning non-residents, it's very important for them to create wealth in India.
And many of them also have inherited wealth in India, which is again equally challenging. So how do you manage the inherited wealth as well? So for us, we see this as a huge opportunity for the future, and of how they can also participate.
So if I were, a high net worth individual and I needed to decide on which is the wealth manager I need to sort of engage to sort of solve these problems that I have, how do I go about doing it? Because today typically what happens, it's about brand, it's about the image that you have, it is about recommendations that I get from friends and family. But how do I actually benchmark, all the, wealth managers that are available in terms of, what are the kind of investment returns they would be able to deliver to me? What are the non-investment related services that they sort of, they're able to provide me? Who is the best in communicating all this stuff to me? Because is there really a platform? Is there some place I could go and try and figure this out?
Unfortunately, there isn't, Shashi. I wish there was, but there is no one repository where you can actually see who is there and who is suited to you. And I think that's something which, it doesn't exist at this moment. But I think what I will say is that in this business, client referrals is really one of the largest ways in which you can attract clients, because if one client has a good experience, and when I say good experience, it's not just about helping solve a non-investment related problem, it's also on investments, because as you did rightly say, at some point they will ask you the question is, am I making more than benchmark or less than benchmark, and how is it doing? And if you're able to get that group of believers, then it really makes life a lot easier. And we've seen that at Waterfield. We've got really believers. Most of our business comes through client references and referrals. And that's something that we also pride ourselves in. And we want to be that good and honest player in the market.
Right.
Because I think India lacks that currently, and we have something to offer.
Right. Thanks so much for your time, Soumya. This has been
Thank
a
you.
fascinating discussion.
Thank you.
And I'm sure there'll be a lot more people who will sort of take this up as a serious opportunity and sort of provide these wealth management services to the HNIs and the further down, maybe even the sort of emerging class of people who've got wealth. Thank you so much.
Thank you, Shashi. It's been a pleasure.